Ever wondered what a balance sheet really tells you about a company? Well, let's dive into it. A balance sheet, in essence, is a snapshot, a financial selfie, if you will, taken at a specific point in time. It's comprised of three main components: assets, liabilities, and equity. Think of assets as what the company owns, liabilities as what it owes, and equity as the company's net worth. Consider it as a financial X-ray of a company's skeleton, showing what it owns, owes, and the net worth. Imagine a fictional company, Cup of Joe, a popular coffee chain. Let's brew up an understanding of balance sheets using this aromatic example. Firstly, we have assets. These are the resources Cup of Joe uses to run its business. Picture shiny espresso machines, bustling buildings, and the scent of crisp banknotes in the till. These are all assets, the tools Cup of Joe uses to serve up that perfect cup of morning cheer. Next, we stir in liabilities. These are what Cup of Joe owes to others. It might be a loan they've taken to buy those fancy espresso machines, or the rent they pay for their charming buildings. It's like a tab at the bar. You've enjoyed the drinks, but at some point you've got to settle up. Lastly, we come to equity, a word that might sound as confusing as a decaf, non-fat, no-foam latte. Simply put, equity represents the ownership interest in Cup of Joe. It's the money that would be left if Cup of Joe sold all its assets, those coffee machines and buildings, and paid off its liabilities, the loans and rent. It's the leftover foam on your cappuccino, the real value of the business once all debts are paid. So the balance sheet of Cup of Joe gives us a quick snapshot of what it owns, what it owes, and what it's worth. It's like peeking into the company's wallet. So, what have we learned from our deep dive into Cup of Joe's balance sheet? Well, first and foremost, we have understood that a balance sheet is essentially a financial selfie of a company capturing its monetary pose at a given moment. It's a snapshot of a firm's health, showing us what it owns, what it owes, and who really holds the purse strings. Let's recap. Assets, they're the things the company owns. This could be anything from coffee machines to intellectual property rights for the best espresso in town. Then we have liabilities. These are the debts the company owes. It could be loans for those fancy coffee machines or payables to suppliers. And finally, equity. This is the ownership interest. It's the difference between assets and liabilities. Getting a handle on these elements can help us gauge a company's stability, liquidity, and financial flexibility. It's like reading the company's financial tea leaves. Remember, the balance sheet is the financial mirror of a company, so next time you pick up a balance sheet, you'll know exactly where to look and what to look for.